Good morning, everyone, and welcome to today's webcast. Today, the title of our webcast is Maximizing the Audit Experience for Nonprofits. I'm Max Smith, and I'm the Digital Marketing Manager for 501c Agencies Trust. Today's webcast is brought to you by 501c Agencies Trust. 501c Agencies Trust has been providing unemployment risk management services since 1982. It is the largest and oldest such organization in the country. We provide educational claims management, savings, and protection services to 501c3 organizations. Today we have a partner on our webcast, Gelman, Rosenberg, and Freeman Associates. They are a CPA firm located in Bethesda, Maryland, and they have wide-ranging resources and have worked for a while with nonprofit organizations, and they will be joining us today. I have a couple of quick housekeeping items for everybody. First of all, this is an hour-long presentation. We will end directly at 1 o'clock Eastern, so we won't waste anybody's time. We'll get in and out real quick for you. If you have any questions, please submit those in the question dialog box on your screen. It is in the bottom left-hand corner. We will try to answer as many of those questions as possible at the end of our presentation. We want to go through the whole thing today, and then we'll try to round up everybody's questions at the end. Today's session is worth a CPE credit for those of you with your CPAs. We will be auditing your attendance and forwarding you the information you need for that credit after the webcast. You can see also in the bottom left-hand of your screen, there is a downloadable PDF of today's presentation, as well as information about our partners on today's webcast. The webcast is also available on demand, so if for some reason you want to forward it to colleagues or anybody else, you can. If you need to watch it again, you can watch it again. And if you're watching today's presentation also on demand, if you have any questions, you can still submit questions in the dialog box. Those questions are emailed to us and our presenters, and we can get back to you with any questions. And we'll hope that you will be joining us for future webcasts. We typically do this once a month, typically at the end of the month, but since November has Thanksgiving, we decided we'd do it at the beginning of the month this year. Let me introduce to you our speakers today. We have Walt and Alan. Walt is actually I have Walt, I have your organization wrong on the screen there. He's, of course, with Gelman, Rosenberg, and Freeman. And he has 13 years of accounting experience in the private sector and a wide-ranging access with nonprofits. Also, on today's webcast is Alan Lesher. He is the CFO and Financial Director of the YMCA of the Inland Northwest in Spokane, Washington. And Alan is actually also a member, a board of trustee for 501c Agencies Trust. So, gentlemen, if you're ready, let's go.
Well, thank you, Mac, and good morning, everyone. First of all, we would like to thank you for attending today. During today's webcast, we plan to discuss why you may need an audit, what an audit includes, final products and reports of the audit process timeline, how your auditors think, questions to consider when reviewing the management letter draft, and 15 tips to maximize your audit experience. Now, the first item that we'd like to cover is why an audit. You have three options when considering whether to have an audit. There's the audit, a review, or a compilation. Now, with an audit, the audit provides the highest level of assurance on your organization's financial statements. The audit, it basically states whether that they're free of a material misstatement and are fairly presented based upon generally accepted accounting principles. Your review provides limited assurance on the organization's financial statements. During a review, inquiries and analytical procedures present a reasonable basis for expressing a limited assurance that there's no material modification required to those financial statements and that they're in conformity with general accepted accounting principles. This is more of a does it make sense analysis that's useful when your organization needs some assurance about their financial statements, but not the higher level of assurance provided by an audit. Then the third option is a compilation. Now, with a compilation, there's no assurance provided on the organization's financial statements. Your CPA basically takes your financial data that you provide, puts them into a financial statement format that complies with generally accepted accounting principles. There's no testing or analytical procedures performed during that process. You'll want to determine whether your nonprofit needs to have an audit, because not all nonprofits are required to even have an audit. Usually some circumstance will require that the audit is necessary. And those could include things such as the federal, state, and local governments may require that you submit a copy of your organizational financial statements that are audited. You may spend $750,000, formerly $500,000 more in federal funds in a year, and so you're subject to certain special audit requirements. Some contracts with a state or local government may require that you conduct an independent audit. You may have state laws related to registering to issue state charitable gift annuities, or possibly to register for charitable solicitation and fundraising purposes, and that may require an audit. You may also submit grant proposals to some private foundations, and they may require that audit. One of the most important for a lot of nonprofits is your banks may require that audit as part of the condition of receiving a loan. And then also, you could even have bylaws that require that the organization submits to an audit.
Now, there are several deliverables the auditor will prepare and provide during the audit process. The first one is the audited financial statements with the auditor's opinion. Please note the financial statements and footnotes are the responsibility of management, and the opinion is the only disclosure that belongs to the auditor. The next is the AUC 265. This is the auditor communicating internal control-related matters to those charged with governance. This letter is broken out into material weaknesses and significant deficiencies, which we will cover later in the presentation. And the last audit report issued by the auditor is the AUC 260, which is communication to those charged with governance. Now, back in July 2009, the Financial Accounting Standard Board, FASB, created the codification to reorganize the many U.S. GAAP pronouncements into a consistent structure called the Clarity Standards. This system was created to reduce the amount of time and effort required to research any particular accounting issue. So AU stands for audit, and C is the codification, and the next three numbers are the number for that. And you could go to any search engine for like a Google and type in AUC 265, and it will provide you the pronouncement and what is entailed with it.
With regard to the financial report that's generated as a result of your audit, you'll create several financial statements: your statement of financial position, your statement of activity, statement of cash flows, statement of functional expenses, and then also notes to the financial statements. The nonprofit's statement of financial position, that's similar to your balance sheet. Basically, it reports your assets and your liabilities in some order of when the assets will turn to cash or be fully expensed, and when the liabilities will need to be paid. Those amounts that are listed on the statement of financial position are as of a specific date, so it really reflects a point-in-time report. Now, this financial statement is built using a simple equation where your assets equal your liabilities and your net assets. Since a nonprofit doesn't have owners, that third section, the net assets, it's basically takes the place of what you would consider in the for-profit world of the owner's equity or stockholder's equity section. Now, the net assets for a nonprofit are also broken down into three groups or three categories: unrestricted net assets, temporarily restricted net assets, and permanently restricted net assets. The classifications are based on the restrictions that are made by the donors at the time of their contributions. The next one you have is the statement of activities. Since a nonprofit's primary purpose is to provide programs that meet certain societal needs, it issues a statement of activities instead of an income statement. This statement reports revenue expense amounts according to the three classifications of net assets: the unrestricted, the temporarily restricted, and the permanently restricted. Then you have your statement of cash flows. In the statement of cash flows, that's very similar to what you would see for a for-profit business. It reports the organization's change in cash and cash equivalents during the accounting period, and it consists of three sections: your net cash from operating activities, your net cash from investing activities, and your net cash from financing activities. Now, while the statement of cash flows is probably the most difficult to put together, and I think most people will agree with that, it's also probably the most important financial statement for a lot of the readers. The final statement is the statement of functional expenses, and this is an optional statement in most cases. It reports the expenses, but not the income, by their function. That would be by program expenses, management and general expenses, and fundraising expenses. And it also breaks it down by the nature or type of those expenses for salaries, rent, that type of thing. Again, those are not often required statements, but they are recommended. And then finally, you have the notes to the financial statements. And in the notes, they basically provide several pages of information at the back of those financial statement reports that talks about the nature of the nonprofit's activities, as well as a summary of a lot of the significant accounting policies. They may include information on your land, building, and equipment, your investments, your notes receivable, your debt, any other commitments that you may have.
As noted earlier, the audit provides the highest level of assurance. But please keep in mind it provides reasonable assurance and not absolute insurance. I mean, in today's world, nothing is absolute. There are 4 different opinions an auditor can render on the internal financial statements. They are an unmodified, a qualified, adverse, or disclaimer. An unmodified opinion is a clean opinion and is something every organization makes every effort in achieving. The other opinions, which are not considered clean opinions, would be rendered if there was a scope limitation or inadequate financial disclosure that potentially can make the financial statement presentation materially misstated. Another could be significant departure from generally accepted accounting principles, or the auditor was not able to perform test work on a certain component. Let's say the nonprofit has operations over in Germany and we were not able to audit any of their numbers. This would impede the auditor from rendering a clean opinion. The AUC 260 letter is a formal letter addressed to the board. This letter communicates the responsibilities of the auditor in relation to the financial statement audit. And it provides an overview of the scope and timing of the audit. So any problems or issues encountered during the audit process are communicated through this letter. Additional disclosures included in this letter would be any new accounting pronouncements from one fiscal year or calendar year to the next, and any disagreements with management on how an accounting pronouncement or a transaction was presented could also be included in this letter. Now, the AUC 265 letter, in my opinion, I believe this is the most important audit report for the board and management to review. The audited financial statements are just as equally important, but in theory, the board and the audit committee should already know the internal numbers, unless there were significant audit entries proposed during the audit process. This letter discloses any internal control deficiencies encountered during the audit process, and the structure of the letter is separated between material weaknesses and significant deficiencies. Material weakness, and I quote, is a deficiency or a combination of deficiencies in internal control such that there is a reasonable possibility that a material misstatement of financial statements will not be prevented or detected and corrected on a timely basis. And a significant deficiency is less severe than a material weakness. The auditor's judgment will distinguish between what is material versus significant. And it is the auditee's job to push back on the auditor to explain why they believe something is material versus significant. I recommend talking it through and communicating with your auditors. Some comments may be downgraded from material to significant deficiency. I also recommend all clients insert management responses or a corrective action plan with the auditor's comments. This will give the reader of the letter management's perspective. I also want to note the AUC 260 and this letter, the AU 265 letters, are addressed to the Board of Directors and management, so this information is not circulated. However, sometimes donors would like to see the AUC 265 letter just to determine if there were any findings, deficiencies in internal controls, just to ensure that there are controls in place and that there were no findings. They look at it for funding purposes. Now that we've gone through the different auditor reports, let's move on to the next topic, which is setting the audit timeline. The PowerPoint slide here depicts the order from start to finish. One thing I want you to notice is the audit committee or board of directors should approve the audit reports prior to finalizing. Additionally, when selecting the on-site fieldwork dates, you may want to make sure the dates are reasonable and manageable for your finance team. You know, with auditors asking questions and requesting documentation, this could potentially disrupt your workday. And I recommend not picking an audit day that is so close to the end of the calendar or fiscal year. Reasons for this are disbursements may be lagging, and there could be other subsequent events that could play a material role in the financial statements for the period under audit. Now, several weeks prior to audit fieldwork, the auditor will provide an audit planning package. Each audit firm will have their own unique audit planning package, and my firm that I work for, we provide several questionnaires, and one of the items in the audit package is the prepared by client or PBC checklist. This is probably the most important document, and it is a detailed checklist of what reconciliations and documents that will be needed and requested during the audit process. The other control activity questionnaires and control environment checklists help the auditor assess risk and evaluate the internal control environment. I can't emphasize enough how important it is for auditors to obtain these forms, 1 to 2 weeks prior to audit fieldwork. This allows the auditor to assess risk and the internal control environment. Now, once the audit fieldwork starts, the whole audit process normally should take 4 to 8 weeks from start to finish. Of course, this is all predicated on the budget size of the organization and the preparation of the schedules prepared by management, and of course the accuracy of the financial statement numbers. Also, one other thing that could hold up the process is when is the audit committee or board of directors able to review and approve the reports? And it also is predicated on what is the auditee's policies with respect to approving the audit reports. Is it just the audit committee chair? Is it all the audit committee members? Is it just the board of directors? So this could play, this could be some delay in when the audits go final, since governance should review and approve the audit reports prior to finalizing. Now, to issue an opinion on the financial statements, auditors need to gather evidence to support the unaudited financial statement numbers. And there are many different ways in which auditors gather this information. We will look at financial trends, maybe looking at 2 to 5 years of data and the fluctuations from one year to the next. We will review subsequent receipts and subsequent disbursement transactions, looking at subsequent events, ensuring all significant accruals are recorded in the appropriate fiscal year, and receivables are deemed collectible. We will perform internal control test work, and this is done by performing observations, looking at who opens the mail, who prepares the bank reconciliations, who posts transactions in the accounting system. Another is examination. This is looking at the corroborating documentation and reviewing the internal control policies to ensure compliance. And lastly, we will perform inquiry with various personnel, talking with people, asking pertinent questions to ensure there is no management override of controls and no fraud or other improprieties. Additionally, auditors will perform tests of details on account balances and will send confirmation letters to attest balances, cash, investments, lines of credit, maybe receivables. Now, to determine which tests and questions will be asked, and this is how you can generalize how the auditor thinks, there are 5 assertions that auditors will use when designing the tests and questions they will ask during test work. The first assertion is existence or occurrence. Does this item really exist? Auditors will perform inventory counts to ensure that there is actually inventory that is on the books as of calendar or fiscal year. Completeness, is this all of it? Rights and obligations, does this client really own this, or is this just a pass-through? Were these funds given to the tax-exempt organization only to be given to another organization? Valuation and allocation, is this valued at the correct amount? If you get donated items or commodities, how are these items valued? And presentation and disclosure, is this properly presented and disclosed in the financial statements? Now with these 5 assertions, let's look at an example. We are auditing a statement by the D.C. government that they have plowed 95% of the roads. Existence, did these roads really get plowed? Completeness, are these really all the roads that were plowed? Rights, are the roads that were plowed really in the city? Valuation, if some of these roads are only one lane, should we count them as fully plowed? And presentation and disclosure. Maybe the D.C. government ought to say that the roads in D.C., 50% are clear and 45% are only passable. Using these 5 assertions, auditors will design their audit test work accordingly to ensure the overall risk of material misstatement is at an acceptable low level. Auditors cannot and will not be able to test every transaction and assertion in the accounting records. It's impossible. It's kind of like throwing a rock and skimming it across the water. We're sampling bits and pieces of transactions from a whole population. And one key note is assessing risk of material misstatement and materiality will always be the guide for auditors of determining which assertions to test. Now, in a snow plowing example, it's unlikely that the D.C. government plowed too many streets outside of the city. And it's also unlikely that the D.C. government plowed very many streets not included in the 95% figure. Therefore, completeness and rights and obligations assertions would not be included. So, in conclusion to the example, the higher risk areas are existence. Did these roads really get plowed? And valuation. If some of these roads are only one lane, should we count them as fully plowed? Now, not to go through each assertion again from the PowerPoint slide, but you could see the same logic can be used when auditing accounts receivable. By creating a confirmation letter, and sending it to a customer or donor or other third party allows the auditors to test existence and rights assertions. Now, positive confirmation from a customer, confirms the existence assertion in the unaudited financial statements. By obtaining this confirmation, the third party is attesting to the existence. Additionally, when customers confirm that an invoice is owed to a company, this proves the assertion that the auditee has a right to this asset it claims in the accounts receivable. Now, let's go through some tips to maximize the audit experience.
Okay, the first tip is really to be prepared to discuss changes related to your nonprofit organization. You may have changes with regard to governance, management, you may have officer changes, changes in key management, changes in your accounting staff. You may have changes in your programs and the operations that maybe you've restructured that organization. You may have technology changes. Have you changed hardware or software? Are you on a new accounting system? Are you on a new payroll system? Has there been changes in the industry or funding sources, particularly new larger material funding sources? And that's early in the planning stages of the audit. It's important to communicate those to your auditor because there may be additional testing that they'll want to do as part of the audit. And if you're prepared to discuss those changes and offer that information to them, they can include that in the initial planning. Another tip is to use the PBC list or that prepared by client list that you get from your auditor as a guide for your preparation. I like to recommend that people sit down with their accounting staff and assign all of those PBC list items to each person so the staff knows who's responsible for that. What's the timeline? Are those timelines realistic? Do you have people that are going to be out on vacation or anything? You need to build those in. Then also as part of that list, if you can number each one of those items, and as you're preparing the information, assign those numbers to the information that you're going to be giving to your auditor, serves as an index for them so they don't have to spend a lot of time searching for the work papers related to any particular testing they're doing. If you aren't sure what they're asking for and need a little clarification, don't be afraid to ask your auditor. Ask for clarification. Ask for a template for a worksheet, or maybe copies of the prior work papers that you can provide to a staff who might be building that worksheet, so they have something to go by. And if there's a particular schedule that's been requested, and you may find that there's other ways to show the information, and those are just a simple discussion with your auditors.
Tip 3, be ready to explain significant actual to budget and prior year variances. Performing analytical procedures and looking at the account balances is very important. And as management looks at this and the finance, there should be a good reason and rationale why items, increase or decrease from one fiscal year to the next. Also, looking at the statement of financial position or the balance sheet, if you have account balances, assets, and liabilities that haven't changed from one year to the next, there should be a good rationale and reason why this payables hasn't changed or why this receivable hasn't changed. Is this receivable not collectible? Or this payable, do we not owe this vendor this money anymore? So these accounts should be scrutinized and looked at to ensure that these numbers are good going forward.
Tip number 4 is always reconcile your detailed schedules to your GL account totals. As you're going through the audit process, sometimes that can be a lengthy process. You start building those schedules early in the process, and you make additional adjustments. And so you want to make sure that when you're done and you're ready to provide this information to your auditors, that those schedules are up to date and have included any of those adjustments.
Tip number 5. If you do nothing else, make sure that the beginning net assets, this is your unrestricted, temporary restricted, or if you have endowments that are permanently restricted, make sure they match the last year's audit report. Some reasons why the net assets may not reconcile is maybe there were entries posted in the audit period directly to net assets. Another reason could be the prior year audit entries were never obtained or posted into the accounting system, thus causing the anomaly in reconciliation of net assets.
Tip 6 is to reconcile every balance sheet account and focus on knowing what's included in the balances. And you want to go back to what Walt said and think about the existence and the completeness for each of those. And your schedules and your reconciliations should reflect the starting balance from the prior year, the changes, and how you arrived at the balance at the end of the year.
Tip 7, perform your own search for unrecorded liabilities. And this entails, you're looking at, if you're a 12/31 calendar year end, looking at January, February, and March subsequent to the December 31st, and making sure that, all accruals are properly recorded in the appropriate calendar year. I have found that, many times during audits, professional services and legal services, the service was incurred and rendered prior to the calendar year, but they lag. Sometimes they just don't get put in the mail, and so it's good to perform this, because if the service was incurred and rendered, it should be accrued as of 12/31. So performing an analysis and looking at the subsequent disbursements, making sure that all accruals are properly recorded, is very important to ensure that expenses are not being understated.
Tip number 8, learn about your organization's internal control system. Very important that you understand the internal control system in your organization and how it works, and that also you're able to communicate that to your auditors. Your auditors will likely tell you how they would like it documented, but if there's not clear direction there, definitely ask for it. Be thinking about the significant areas where your organization spends money. You'll want to focus your efforts there, or where there's a significant number of transactions. You'll want to identify the control areas, the controls for those areas in particular, and you may even want to do some testing yourself to make sure that you and your staff have a good understanding of the way those controls are working when you're portraying that.
Tip 9, and this is just a piggyback on what Alan was saying, learn more about internal controls. Pay attention to what authorizations are required for different transactions. Maybe, certain dollar expenditures need to be reviewed and approved based on the threshold by a different level of people. Another one is, who is approving the expense reimbursements and credit card charges incurred by the executive director? It should be the tone at the top. So someone of governance, should be, reviewing the expenditures of, the executive director to ensure that the transparency and that there's, no personal charges being incurred, and that there's, the business purpose is documented. So I always recommend just best business practices. Have someone designated on the board, look through them quarterly or every 6 months. This shouldn't hold up the reimbursement process, but at least you have someone at the board level, reviewing the expenditures of the executive director. If possible, always make sure that someone outside the accounting process is reviewing the bank statement and reviewing the bank reconciliation. And I recommend someone out of finance should be doing this just to have, adequate segregation of duties. Making sure that, they're looking at the bank statement, and if anything stands out, there's any anomalies or anything that's just, uncanny, should be really looked at and scrutinized and ask the question to your finance people. Ask them why are there, 3 wire transfers out all the same amount for, $20,000 for any particular month, And then, maybe there's a good explanation, but at least you're doing your due diligence and you're looking at the bank statements and the bank reconciliations. Consider the controls over payments not made by check. Try to get the process for these to match those for checks as closely as possible. With checks and, being in process, there's a clear line of, you could go to the bank statement, you could see the check number, you could go to a lot of the bank statements now are like these little scanned copies and microfiche where you have the copy, and they also have a scanned copy of the back so you could see who endorsed it. I recommend that, you don't do cash payments. At least with checks, you have a paper trail. So I highly recommend, if you're doing a lot of cash payments, transition over to a check system or to use AnyBill or something similar. And number 5, remember that a credit card slip is not an invoice. Credit cards are scrutinized by all auditors because the transaction occurs prior to any review and approval process. I've done many audits, and it's, credit cards are sometimes overlooked. And, you'll see sometimes personal charges are being incurred on them, and that's because no one's looking at it. So I highly recommend that receipts are obtained, and also that you have strong policies governing the credit card slips and what should be retained to corroborate the transactions.
Tip number 10 is think about the steps in producing the audit report that you rely on the auditors for. Before the audit even starts, you may want to talk to them about what are the implications of relying on them to complete certain items. Oftentimes the time that they spend translates into a fee. And so if there are certain schedules that you're able to prepare as opposed to having them do them, you may see the benefit of that through your reduced audit fees. And even in the event that you do have the auditors prepare schedules, it's often to your advantage to be able to show the auditors that you're able to prepare those schedules. Gives them a certain level of confidence that with regard to the skill set, they're going to be formulating an opinion on those financial statements. So it's important that they feel confident that the staff are able to understand the generally accepted accounting principles.
Tip 11, keep in mind that there may be a benefit to identifying adjustments that are needed, even if you aren't going to fix them. This helps to avoid the possibility that the auditors will say that you failed to detect them. I highly recommend communicating with your auditor prior to fieldwork about questionable adjustments just to get their perspective. The auditor and client communication should be open year-round and is not just during audit fieldwork. And I have found that the mentality with the auditor and client relationship shouldn't be that we're out to get you. On the contrary, we are here to help.
Tip number 12, Establish an auditor file, and throughout the year just gather copies of anything that might be related to reports from outside consultants, regulatory agency inquiries, or any internally developed strategic plans. You may have fixed asset additions or disposals. You may have new debt or lease agreements. You may also have new contractual obligations. Possibly you're involved in a lawsuit. There may be some new complex transactions. With those items, it's a great idea to involve staff in that. As those things come up, let's remember to put a copy of those, and for a lot of us, those are electronic now. Start that folder January 1, and so by the time we get to the time of the audit, a lot of that information's already done. It's just one item that relieves a little stress on staff. And in this day and age, the auditors are all working with electronic copies. So if you're able to place that in an electronic format to begin with, it's very easy to then transfer that information to the auditors.
Tip 13, if your organization receives contributions, make sure you have considered and documented any time and or use restriction imposed by donors and tracked any use of restricted funds. The auditee will be required to document how the organization met the donor's terms and restrictions. Whether it was based on incurring costs, completing the project, and or meeting certain milestones. Tip 14, if your organization receives grants, make sure you have copies of all grant agreements in an organized set of files. It is extremely helpful to prepare a quick summary of each grant listing the basic terms, conditions, and reporting requirements. And as Alan said earlier, I would create a file for all grants and have it separated by calendar or your fiscal year end. This way you're not running around trying to find award letters when it's time, for audit field work. Foundation grants. These are often one of the more confusing areas. Consider whether these contributions are exchange transactions. For every dollar incurred, you recognize the revenue. Or if they are a contribution, consider whether they are restricted or not. As I was saying earlier, they could be restricted due to the purpose, a certain program, or they could be time restricted. Consider whether you should record a receivable for any future payments. You'll find this in pledges. Sometimes, someone is going to pledge, $1 million over 5 years, and you'll get $200,000, a year for that. The whole pledge should be recorded. And that would be based on the time restricted. So just making sure that you're recording the full pledge amount is very important.
Now, as a bonus tip, keep in mind you want to be open and candid with your auditors. You're going to be asked about questionable accounting practices and procedures. You're going to be asked about fraud risk factors. You're going to be asked about known deficiencies in accounting systems. It's better to be aware of those items and to share those with your auditors than to have your auditors discover those issues during their testing or their interviews with other staff. It's not really intended to be a performance evaluation. As CFOs and finance directors, we tend to look at it as a report card, but it's really to determine whether we're fairly representing those financial statements and allow the auditors to issue that opinion.
Stay in contact with the auditor throughout the year. Even the strictest independence rules allow auditors to do an unlimited amount of teaching. I touched on this earlier. The relationship should not just be based on when the audit period or the audit time. It should be year round. And also, the auditors can provide you with tools to make decisions, but we cannot make the decisions for you. We could help, and if we were making decisions for management, that would impair our independence. So in conclusion, focus on understanding and documenting internal controls. Expect to need to do more of the year-end cleanup. Focus on the ability to get the final product. Preparing for the audit will make more time, but probably cost you less in the end. And remember, we're a service provider. We are here providing you a service. So, we are here to help you in any way and help you with your endeavors and your growth.
All right. Thank you, guys. You need to take a sip of water because we do have a full stock of questions here for you. And remind our audience that if any of this sparked anything and you need to have a question answered, please put that in your Ask a Question box, which is right below Walt's picture currently. So we'll try to get to as many as possible. I'll start here at the top. One viewer says, it sounds like you are discouraging payments of invoices through ACH, preferring checks. Could you all comment on that? Is that what you're kind of pushing or no?
I'll touch on it. No, I was discouraging if you're making cash payments. Wire transfers out, ACH I'm fine with. It's more of I've gone to clients and they're paying people, and I see a lot more of this when I'm doing my A133 audits. If I'm going to Afghanistan or Iraq or anywhere in Africa, you see a lot of cash payments are being made. With cash payments, you don't have a clear trail. With at least checks, you have a trail. There's a little more contemporaneous documentation, than just cash payments. So I was not trying to discourage that. It was more of if you're making cash payments.
Okay, great. We do have a couple quick questions about where the slides are located. If you all look in your bottom left of your screen, you'll see a tab that says Event Resources. If you click down on that, you'll see two PDFs, two files there. One's from Walt's organization, and then one is a copy of the slides. So that's where the slides are located for everybody. The tips and overall presentation were extremely helpful. If we need to do an RFP of an audit, are there any tips on putting one together or what to include?
Just making sure in the RFP process you include all the services that you will need. I know in New York we have a lot of nonprofit tax-exempt organizations. They have to fall under the New York Nonprofit Revitalization Act. They need to do a SHAR 500. We could perform that. Also, what other tax return services are you going to need? Also, are you if you're getting significant federal funds, and Alan touched on it earlier, it's now the new threshold is, it will be as of for December year ends, it will be $750,000 in federal expenditures. Do you need to undergo a uniform guidance audit, which formerly was called an A133? So just making sure in RFP you communicate all the scope of the engagement that is required. And just be open and frank. What questions, when the auditors come in to present, be candid and open. What issues have you been having, and so forth.
Okay. I have a question from Dave about selecting an auditor. The recommendations about the process behind that. Do you guys have any recommendations about that?
Well, when we conduct RFPs every 3 years for our organization, and we'll tend to ask for their qualifications, but we'll also include a group, a finance committee group, to scrutinize those RFPs, and we find that very helpful.
All right, just to chime in, a couple other things. Yeah, Alan touched on a really good point. There's a lot of firms that we partner with, and tax exempt. The nonprofit arena is so different than the for-profit arena. So if you have an auditor that is not proficient in working with tax-exempt organizations, and it's going to be very hard for them to do the audit, especially with respect to the revenue stream that particular client may have. Auditing federal versus non-federal awards is a lot different. So you just need to be mindful, does the auditor have the experience in performing your audit?
Okay. And how about if an organization gets attached to an auditor, to a particular firm, is there any rules, best practices for how long to retain a particular firm? Should organizations be switching every few years? Are there any rules about that?
Under Sarbanes-Oxley, and this is for, publicly traded companies, every 5 years they recommend that there go an RFP process, and you go out and change your auditor. At our firm, what we have done for our clients is we will transition the partner and the staff so that you have a clear set of eyes. The answer to the question, there is nothing. There's nothing that prohibits you from doing that. I've read many different journals and literature on, it could be good to transition audits every 5 years, but it also can hinder the organization. Because sometimes, when you have an auditor for, multiple years, they know the history of your organization. They know how you are handling transactions. So there's really nothing for nonprofits that say you have to transition every 5 years, and it is best business practice, but you can always transition, do a rotation of partners and rotation of management, so you are getting a new set of eyes looking at the documentation. Okay.
Excellent. So, and we have a lot of questions rolling in. Like I said, I'll shoot the guys as many as possible that we can cover here on air, and some of the more pertinent ones we should be able to follow up with via email later. And also for anybody who's watching on demand, if you have questions, you can definitely submit those as well, and we'll get those by email. So we have one viewer, Chris, who said that just taken over for somebody else and didn't have anything automated. And Chris has just finished moving everything over into an accounting system and is wondering how long to wait before scheduling an audit, maybe let some of these new practices take hold.
I'm sorry. What? Can you repeat that? So they have a new accounting system and
right.
Transitioning.
Yeah, the transitioning, and how long do you think they should let those new practices take hold before perhaps scheduling an audit?
I mean, well, I wouldn't wait too long. It depends on your funding stream, and are you required to undergo an audit, and do your donors require it? There's if you wait too long, then you could be delinquent in timing. And sometimes I've had clients that went from QuickBooks to Great Plains, or change their accounting system 1 month prior to the end of their calendar or fiscal year, and they had some kinks. We, as auditors, they should be able to to work with the client, try and find the common ground. If you could get the auditor to the number or the methodology of how you came up with that, and it's reasonable, then I think there shouldn't be any problems. I'm just what's throwing me off is the kinks. If you're having significant kinks where you can't even get cash reconciled, then it may make sense to hold off until you work with the accounting system provider to help you through those kinks. But I wouldn't wait too long. I would.
Gotcha. I understand. Sooner than later, in other words. A couple of questions about internal controls. Some want to know how do you test for them. Others are talking about they're a small organization with limited people spread across those duties. Is there any guidance for how to prioritize spreading internal control duties across organizations as they grow?
Oh yeah. We look at we can look at the number of transactions incurred. We have a lot of small organizations at Gelman, Rosenberg, and Friedman where we'll look at the internal controls. Maybe it makes sense just to do walkthroughs and then do tests of details on account balances. We're still looking at the internal control structure, but if there's not that many transactions, maybe we could test less transactions where we don't have to do a full sampling of it. Okay. If that makes sense.
No, it made sense to me. Organizations that maybe use third parties or maybe bookkeeping would be an example. How important is it for those individuals to be part of an audit process?
Third parties being organizations that do fundraising, or third parties who are helping with the finances because there's no finance people at the client or
probably the latter, I think.
Yeah. We have a lot of organizations that just don't have the capacity to have a finance department, so they will use client services to, your part-time controller is a popular one, Rafa, where they will help the organization to reconcile and post transactions. Once again, kind of like the RFP process, if they don't understand tax-exempt organizations, are they going to be a good fit for your organization? Like I said, for-profit versus non-profit, it's a whole different world.
Gotcha. And generally speaking, which staff member inside an organization interacts with an auditor, the point person?
Depends how big the organization is. I mean, the auditors are going to talk to all the finance people. But, if we may talk to fundraising or we may talk to program, if you have a separate department for grants monitoring or subrecipient monitoring and procurement, we probably will be talking to them as well. So it varies. We perform randomly people to perform inquiry with, just to get a basis and to look at just not the finances but the whole organization. So it could be anybody from finance to the receptionist.
Okay, and we'll go with one last question. Mark appears to have a pretty good question here, so let's see if I can get it to you correctly. It's number 27 on your screen if you're looking at it. How should the nonprofit value in-kind donations? He gives an example. We regularly have large-scale corporate donations where the schedule appears to show an inflated value, and our auditor has disputed our FMV determination. Do we just book the donor's value so as to avoid this kind of dispute in the future? Any recommendations?
Very good question. Sometimes the donor is going to give you an acknowledgement letter based on the fair market value. If the auditor is going to dispute that, can we get the cost that the donor incurred for this item? Maybe we could record this item not at the fair market value at the time, but at the cost of the donor. What did the donor incur when they transferred this in kind? And I don't know what the in kind is. Is it pro bono services? Is it commodities? Is it so? It depends. And you also look at your internal policies with respect to how does your organization evaluate in kind.
Excellent. Well, that's all we have time for. I'd like to thank Walt and Alan for conducting our presentation today. I'd like to thank all of you for attending. We have another one in about a month, legal trends for nonprofits to look out for in 2016. You can click the registration button right there on your screen and sign up for that right now. But for 501c Agencies Trust, Alan, Walt, good job. Thank you very much, gentlemen. Have a great day.
Thank you.
Thank you.